Hi everyone, good evening to you all. Uh, Now we covered yesterday up to this formula, and actually we went through a little bit more on this. But just for to recap what we have done yesterday, I will present this part. I will go through this briefly again. Now this present value formula is the one is the or rather the present value principle is the one we use to calculate bond price. So we need to know the components of this, as well as how we are going to uh, get details from bond transaction and apply here in this formula. So what I will do is I have an example. So we will go through the example, and maybe we will be able to finish it today. If we finish it today, then we can do another one together, right? So I would like to have this as a discussion. So everyone should participate in this by, if you have anything, you can talk to me, or any clarifications you should then and there you can raise your hand, and you can on the mic can ask me. So then it will be easier for us to understand, because this is not very complex calculation, but if you are doing it for the first time, then you will find certain things a bit difficult. So going forward, uh, having a discussion would be really helpful for us to understand this. So I will go through. Now I actually went through these things yesterday. Now in the case of a bond, future value is the value of cash flows you get in future. So here you get future cash flows. The future cash flows are future coupons plus the maturity amount. Now the maturity amount is the face value uh, of a bond. Now bond has a face value at the time of issue, that is the maturity amount, right? So we went through this yield to maturity. So in this formula, R is the yield to maturity, and time till maturity. I said yesterday the time till maturity is divided to coupon payment periods. So one coupon payment period we will be taking as one time period. So then it will be easier. Then it will be easier for us to make this calculation, because we take everything for that coupon payment. In the sense, we adjust everything for that coupon payment. So I will we will go through this example first. Now this is a bond. This is a actual bond which we have actual deal which we have done in the bank with another counterparty. So I have taken this because it will be then easier for us to see whether we have got the exact figure, rather than taking something from a theoretical point of view. Now we are in this is a practical subject. No, now you all are practicing this every day, and as well as the other counterparties, the primary dealers, the banks are doing this every day. In the government bond market, or we would say government securities market. So in this bond, the face value was 50 million, and issued date was 15 for 2006, and maturity date was 15 for 2012. So here we have 6 years. 6 years means we have 12 cash flows. 6 years means we have 12 cash flows, and coupon interest is given as 6.85. Settlement date was 9/8/2010. Now we have to think that we are in we are using this as the value date. So we do this trade with a value date of 9th August 2010. So we are in actually 2010, 9/8/2010. So and yield to maturity is 8.7%, right? So it's more the coupon interest is less than the yield to maturity. Now you see here. So this is the example we will be using throughout this presentation for our calculation, right? So coupon interest calculation. First, we will do how we calculate the coupon interest. Now, coupon interest is now in government securities and government bonds, particularly in this example, I said they are semi-annual coupon bond coupon. It's a known fact. Everyone knows that. And payments are done twice a year on coupon dates. So semi-annual means payments are done twice a year on coupon dates. So now here, irrespective of number of days, now if you take two coupon periods, now since we have 365 days per year and we have different days for months like January 31, 28 or 29 in February 31, 30 like that, it goes on, and then we have different number of days for these different coupon periods. But irrespective of number of days in a period, we take equal coupons. So in the sense, the we calculate the annual coupon and divide it by 2, to get the 6 months coupon. So this is equal. So we don't calculate or we don't adjust this for number of days, right? That is very important because this is a norm in this calculation and norm in the bond market. And the coupon is calculated on the face value. So if the face value is 100 million, if the interest is coupon interest is 10%, it is 100 million into 10% and divide by 2 for one coupon payment. Why? 10% is an annual coupon rate. So you get 10 million. 10 million is 10 million will be divided by 2 and you get 5 million, right? So coupon interest calculation is like that. So this is how we do the coupon interest calculation. I will explain this for the benefit of everyone, like if you have not come across this, but I'm sure that in your day-to-day transactions with the counterparties, or rather you are in the middle of the transactions. So you must be familiar with these, but only thing I will anyway I will explain this to you. Now this LKR 50 million face value LKR 50 million and the coupon interest rate is 6.85. 6.85 is the coupon interest rate. LKR 50 million is 6.85%. Sorry. Face value LKR 50 million into 6.85 you get here, and why this is 100? Because it's a percentage, so it's 6.85 over 100. So that is why I have put 100 here and divided by 2. So in this bond, the coupon payment is 1,712,500. This is the coupon payment. So it's very simple, no? It's a very simple calculation to get the coupon payment. And now we move on to the accrued interest calculation. So what is accrued interest? Now accrued interest is the interest accumulated from a last payment to the next payment or to the settlement. So it can now we know a coupon period. Now say suppose if a bond is now this bond, we'll take this bond. This bond was issued in 15/4/2006. Issued in 15/4/2006 and maturity date is 15/4/2012. but 2010, 9/10/2010 is the settlement date. So now we should know what was the last coupon before this settlement date. What was the last coupon before the settlement date? It was 15/4/2010, right? Is it clear for everyone? Can I get a feedback? Hello? Is it clear? Or you want me to explain again?
So can you repeat again, please?
Yes. Now, thank you. Thank you for your feedback. You asked like that because then I can, I know that how to adjust my speed, right? Then now it's like this. Now this bond was issued on 15/4/2006, right? 15/4/2006. So it's maturing on 15/4/2012. So in this bond, the coupons are paid every 6 months. No, now so the first coupon uh, was on 15/10/2006, right? 15/10/2006. Then the next one was 15/4/2007. So the coupons are 15/4 and 15/10, right? That is 15th of April and 15th of October, right? Starting from 15/10/2006, because just after 6 months from the issue date, right? So, but only thing, now paid coupons we are not bothered about, because paid coupons are already given to the holder of this bond at that time. So we are not bothered. Now say someone has this bond today, that is in now we are in August 2010, right? So someone who is having this bond today, we will consider today is maybe today we can say we are in August 2010, right? So someone who is having this bond is trying to sell or trying to calculate its price as of 9th August 2010. A trade has been occurred and settlement date is 9/10/2010. So we need to calculate now. Now actually 9/10/2010 is in between two coupons. No, 9/10/2010 is in between two coupons. That is the coupon before 9/10/2010 and after 9/10/2000. What is the before coupon? 15/4/2010. The before coupon was 15/4/2010, right? Then the after one, after coupon after the settlement date, the coupon is will be on 15/10/2010. 15/10/2000. So our coupon period is now in this current scenario. If we assume that we are in August 2010, then our last coupon was 15/4/2010, and the next one is 15/10/2010, right? That is after this settlement date. So now my here what we need to know is, now there's some part of interest which has already,
Excuse me, sir.
sorry, yes,
The first coupon date was 15/10/2006. Sorry.
15/4. Now the last one was, now we are in August 2010. No, now we
Yes.
are in August 2010. So the last coupon was, lastly paid coupon was 15/4/2010. Is that clear?
Yes, sir.
Yeah. So 15/4/2010. But the next coupon would be 15/10/2010, right?
Yeah.
Clear, no?
Yes, sir.
15/10/2010. So that is our current coupon period. Now, for that, now on 15/10/2010, we will be getting 1,712,500. The holder will be getting That is the coupon interest, no, right? But now the holder needs to sell this bond, right? Now he needs to sell this bond. So the expected yield to maturity uh, is 8.7, right? Is 8.7, and we need to calculate now. Now he was having this bill, having this bond for a long time. Maybe lastly he got this coupon on 15 for 2010. So from 15 for 2010 to 9/10/2010, interest for that period is uh, that period belongs to whom? Belongs to the current holder, no? Or the seller, we can say. We can say the seller of this bond. He is trying to sell this, right? Is that part clear? So he should get that interest. He should get that interest. That interest is called accrued interest, right? That interest is called accrued interest. But only problem here is at the time of settlement, right? Uh, uh, the coupon will not be settled. That is, coupon will be settled by the central bank, right? By the central bank, or on behalf of the government, the central bank, right? The right wording is that. So the central bank will be acting as the banker to the government, acting as the banker to the government, will settle this coupon on the next coupon date. The next coupon date is 15/10/2010. 15/10/2010. But by the time they pay the coupon, the ownership has changed to someone else, right? So that other person, the new owner, will be getting the coupon. But the interest from 15 for 2010 to 9/8/2010, that is till the settlement date from the last coupon. I will go to this slide. That is from 15 for 2010 to now the current coupon is 15 for 2010 to 15/10/2010, right? So accrued interest is the interest accumulated from the last coupon to the day before the settlement date. So day before the value date means it will be accumulated till that. Now to perform this calculation, we need to know the number of days for the current coupon, right? So current coupon is 15 for 2010 to 15/10/2010. So now this calculation I have given here. Now 15 for 2010 means now last coupon was paid up to which date? 15 they are paying the coupon means up to 14th April. Up to 14th April. So from 15th to 30th, inclusive of 15th, right? Inclusive of 15, you get 16 days. So I have given here the calculation 30 minus 15 plus 1. So 16 days in April, right? And then May, you get 31 days. June, you get 30 days. July, 31. And again, August, 31. And September, 30. October up to 14 because they are paying it on 15. The coupon date is 15. The maturity date is also 15th of April 2012. So here up to 14th only the interest will be paid. So for October you get 14 days. So total number of days for this particular coupon, that is starting from 15th April 2010 to 15th October 2010, then the total number of days for this period is 183 days, right? 183 days in the current coupon period. This in accrued interest calculation. Now here we have arrived at days in the current coupon period. So number of days in the current coupon period is 183 days. Can I know whether you understood this, everyone?
Yes, sir. Understood.
Yeah, this is easy actually, because this is you are calculating number of days between between two coupon periods, right? Or you can, in other words, you can say number of days in the current coupon, right? Running coupon. This is running coupon. Why I say this is running coupon? Because we assume that we are in August 2010, right? August 2010, and August 9th is the settlement date of this trade, right? So we go to the next step. In accrued interest, days in last coupon to the settlement. We calculate from to the settlement. So here, what we take is, we don't take this September 1 and October 1 because the settlement date is 9th. So 9th we settle. If we settle on 9th, the interest will be, now, if I sell a bond on 9th of August, right, I am entitled for interest up to 8th of August, right? Understood, no? Up to 8th of August. So we are calculating number of days. We are calculating number of days from the last coupon to the settlement date, right? So last coupon was on April 15th. So we calculated this earlier as well. Now we have 16 days in April, we have 31 days in May, we have 30 days in June, July we have again 31 days, and August 8 days, right? So August up to 8 days only we are taking, and September and October we are not taking. But earlier we have taken here 31 days and these two to calculate the number of days for the entire period, right? So now we have in one hand a coupon payment for coupon amount for 183 days, right? 183 days, the entire coupon will be 1.712 but when I sell, say if I am the seller, when I sell this on 9th August, I will not be getting that coupon because the coupon will be paid to the holder at the time of the coupon payment. So holder will be some other person, not me. So I won't be getting this. But in fact, I am actually entitled for interest because I am holding this till 8th August, right? So I am entitled from 16th April, or sorry, rather 15th April to 8th August, right? So that my entitlement should be paid to me by someone else, right? So in this bond market, there's a rule, or rather a norm, that now the buyer will not be now we can do this as well. Now we don't have to say, okay, buyer will say, okay, let's see now, when I get the coupon I will pay you, right? Because he has not got the coupon. No, he will be getting that money in future, so he can always say, okay, I will pay. But here in the bond market, it's not the norm. The accrued interest should be paid at the time of the trade. So that means my interest entitlement for this 116 days should be paid by the buyer to me, right? Plus the bond value, So accrued interest is the accumulated interest from the last coupon to the day before settlement date. Why we say day before settlement date? We can always say till the settlement date, but to be very precise on this, more specific on this, I have put day before settlement day. Then it's clear, because settlement day is the day that we do the transfer of ownership to the other person who is the buyer. So from that day onwards, the interest is interest belongs to him. Not to me. So up to the day before settlement, the interest I should get. Only issue here is there's no person now for me to claim from. That means actually the issue is the government. No, so I now in this case, I should go to the government or the banker, to the government, the central bank, and say, okay, look here, today we are I am selling this bond, so up to today interest you better pay me. But that is not the way of doing in this bond market. So so the buyer will have to pay accrued interest to the seller, right? So accrued interest, now we haven't gone into the calculation yet, but we should know what portion of interest belongs to me, right? What portion of interest belongs to me, because then only we can do that calculation. Actually, from 183 days interest, right? From 183 days interest, I am entitled for 116 days. So that is very simple, right? How we arrive at 116 days? I am taking the number of days from the last coupon I received. I received my last coupon on 15th April. So I am taking from that date uh, to the last day I am holding this bond, right? The last day I am having this bond is the day before the settlement date, right? Can I ask you again the same question, whether you understood, or I need to explain more on this? Can everyone, if anyone has a doubt, please ask, right? Then we can, we can go into this calculation, and we can do some exercises as well on our own, like although it's sometimes difficult to do it in online, but we need to do, and you get to know this very clearly. Just let me know.
Mangala, someone raised a hand. That is Kasapa Tenakona raised hand. Any question?
Yeah, Kasaba, you can ask. I am.
No,
I don't see the.
no, I asked that the question. No,
Yeah.
I asked the question before that's not going away, so that's all keeping.
Right.
I already asked my question.
You asked, no? Right.
You asked, yes.
Hand is still there. Right.
Yes, and it's still there. So
Right. So thanks for your question. Actually, that gave me more courage to explain this, because then I know that you understood this. Anyone else? Anyone else there who would like me to explain more? Or I will further proceed, but in my during that also, during the calculation, you just disturb me and ask, right? If you don't understand, then it will be easier, because we actually need to know this, because this is really we are trying to match the theoretical framework. I am trying to bring this theoretical framework into our practical day-to-day work, or day-to-day. This is our business. So this is mainly treasury and money brokers, the primary dealers. All people are actually into this government securities business, but we should know basis of this, and where these things go and fit in the theoretical framework. So that is the whole purpose of explaining this, right? So this is how we do the calculation. Now, if you have calculators, you just calculate this and see 50 million into 6.85% into 116, right? Divided by 2. That is because why we take this this calculation we already did. This part we already did. Now this part which I have circled is the new part which has come here, right? Only thing here, I just put the percentage mark. I haven't put divide by 100, right? Now earlier one, I just put 6.85, and below you get 100, right? So when you say, you have to be very careful here also. If you remove this percentage mark, you have to put 100 here, right? So you have to include it here. But 50 million into 6.85% divide by 2. That is, we get 1,712,500, right? into 116 divided by 183. Just calculate. If you have calculators and see, you will be getting this amount, 1,085,519 and cents 12, right? If you are using a bond calculator, you can calculate and see what figure you will be getting, right? Actually in this deal, the amount was the accrued interest was one. Now when we did this, that's why I said this is an actual deal, right? So now in an actual deal, all these calculation, as I explained you yesterday, all parties to that should agree with these calculations, right? So if I say now here you get 1,085,000, you now this is understood, no? 50 million into 6.85% divided by 2, and this coupon is for 183 days, so I am calculating 116 days interest. So I divide it by 183 and multiply it by 116. So to know what is the interest portion or portion belongs to the seller. So that is what we call the accrued interest, right? That is what we call accrued interest. So 116 days interest, 116 days interest, in other words, right? So 180 divided by 183 days and into 116 days. So I get this answer 1,085,519.12. If you calculate it from a calculator, simple calculator, you get that one. But my point here is, what I am trying to prove here is, now someone can say, now we don't get this in the bond calculator. Yes, definitely you don't get this in the bond calculator, and even if you feed this data into your system, you can, if you have a test system, you can feed and see, then you will not be getting this 1,085,519.12. Actually, you will be getting the figure below that, that is 1,085,500, right? You will be getting 1,085,500 as the accrued interest. Why there is a difference? Now there cannot be a difference here, because now if I am just explaining you the theory, this 1,085,519.12 figure is correct. But when we try to match this with the actual market or practical scenario, then we can't take it, right? Then we can't take it. Then say, suppose if you want to do a calculation manually and do a deal, that that calculation will be not 100% correct, right? So that is why I'm, now in this deal, I don't have this deal slip actually, but then I actually prefer to show you that, but I'll try to find it out because it's a very old one. But in that deal, it was this 1,085,500. So what is this difference? You can't have a difference. The all parties should agree, no? Otherwise, one would say, no, accrued interest, I should get 519 cents 12, right? But you are paying me only 1,085,500. There's a 19 rupees and 12 cents difference. Like that, someone can say. So someone would say, no, since this is 1912, that we have rounded up to the nearest 100. No, it's not like that. Not that we have rounded up to the nearest 100. There's a norm in this calculation, in the bond price calculation. I will explain it to you for your benefit. Then you can, your actual deals go through, you can calculate and see. Now every day we do government securities, and some are coming, I mean most of the things are coming through through brokers, no? So you can get one, and use this calculation and see whether you get. So then you will be familiar with this, right? So the difference is this. Now in this calculation, we first do this part, right? We first do this part. Sorry, I have just put here percentage mark, but I have put 100 also here, but just forget about this percentage mark here, because since I have put 100 here, no need of having percentage mark here. But then anyway, 6.85 divide by 2 and divide by 100 into 116 and divided it by 183. So first we do this part, right? If you want to do a manual calculation of accrued interest, you do this part first, right? And you get the answer for above, or rather for this, right? You get the answer for this, and the answer is this, right? 0.2 0.02171038251, and you get this, you leave out other decimals and get the decimals up to 6 decimals, right? Up to here, 6 decimals. So 6 decimals is 0.021710, right? Then this fraction you multiply by 50 million. So then you get the exact answer as your bond calculator or your system calculation, right? So this is how we arrive at the bond cal figure. And now accrued interest calculation we did it theoretically. Actually, we did the theoretical way, and we got an answer. And now I want to show you how we arrive the same thing from the bond cal. The bond cal figure is a little bit different. There's a small difference between this figure and the bond cal figure. So, but why it is so, and how we should, what we should do to arrive at the bond calculator figure, we should adopt this method. Now earlier what we did was we multiply 1,712,500 by 116 and divided it by 183. We divided it by 183. So then we got an answer different to the bond cal figure. Why I say this is the bond cal figure? This is the actual deal we did in the bank, and this was the figure for the accrued interest. So this is how, if you want to do manually that calculation, this is how you should do it. So bond cal is programmed for this, to handle this kind of a situation and get the exact figure, because in this calculation, as I said earlier, now for the calculations, for the figures you arrive from the calculations, you can't negotiate. You can't say no, it should be 550. Since it's 519, you pay me 525. There's no such thing in this thing is allowed or happening, right? Why? Then these deals won't take place very smoothly. There cannot be any dispute of these amounts, because then the bond market will really become a very inactive inactive market, because there are a lot of ambiguities. No one would want to come here and do the transactions. So this is why we actually should have our, now say suppose last time, like last time when we did about, say, maybe few years back, this course, someone wanted to configure their system, some broking company, so configure their system to arrive at really at these figures, right? It's sometimes difficult, right? Very rarely you get a slightly different answer, but then there's a solution for that. So they send their software developer to me to get an explanation on that, and they fix that issue. So likewise, so I have before, when Mr. Ratnayaka invited me for this course a long time back, he said 7-8 years back, I think. So then I actually calculated, I got a lot of practically happened deals, and then calculated so many times and checked whether this calculation, the method we are using, now method is correct, that is net present value, but then the way that we do will give us the same figure as the bond calculator. So then only I found that very rarely you get a very slight difference, but there's a fix for that. So if so that fix is there in the bond calculator as well as in the systems. So I hope that you understood the purpose of this. Actually, our calculation ends here. Our calculation ends here, but I just want to show you this because I don't want you all to have a doubt in your minds, because this gives a different figure and the bond calculator figure is different from that. So how we arrive at this is by using this. So we leave out this 50 million and we do this calculation first. 6.85 divided by 200, that is 2 into 100 into 116 divided by 183. So then you get these decimal places, this answer, and then you take this answer up to 6 decimals. Then that this is your multiplying factor. So this factor you multiply by 50 million, then you get 1,085,500, right? Is this clear? Is this clear to everyone, or can someone, if someone needs more clarification, you can ask now. Please participate, then it's good to have a discussion. Then
It's clear, sir.
It's clear, no? Right. Okay. Thank you so much.
Yes, sir.
Yeah.
Thank you.
We will move on to the next slide. So buyer will pay the accrued interest. The buyer will pay the accrued interest of the holding period to the seller. So this is the accrued interest bond market. The buyer will pay the accrued interest to the seller. So now in a bond, now with this accrued interest part, I would like to bring here the clean price and the dirty price concept, right? So clean price of a bond is the actual price of the bond, right? Actual price of the bond. But now this accrued interest part will come here now. So this accrued interest part, you add to the add here, and then you get the dirty price. So clean price plus accrued interest is the dirty price. Or if you want clean price, you deduct accrued interest from the dirty price of the bond. So actually speaking, this dirty price is the total purchase consideration. In the sense, to acquire this bond, a person who want to purchase this bond will have to pay this dirty price amount to acquire the bond. That is, he has to pay the bond price, the clean price plus the accrued interest. So dirty price is the total purchase consideration, right? So a bond price is the amount of money investors are willing to pay for the acquiring the bond, right? Bonds are traded for the yield. As I earlier also mentioned, these bonds are traded for the yield. Why the yield? Because when you say the price, we can't, we can't compare this price, because these bonds are from different. Now if you take a bond, the bond a bond has, now we discuss these features of the bond. Bond has a coupon interest, right? Now if you take different issues, you have different issues, and those issues have different coupon rates, and their maturities are different, their tenors are different, like that. Now if you say this particular bond is, we will say this particular bond, now I will say someone, okay, I have a bond it's I will give it to you at 101 rupees, right? Per 100 units of the bond, 101 rupees. Face value 101 rupees is the price. So then it is very difficult because you have to calculate back the yield, right? But when you deal in a market, you know, right? You know the expected yield of the market. That is, what is the rate, what is the interest rate prevailing in the market, right? It actually depends on the product, but and now that adjustment, the interest free instruments as sorry, risk free instruments as well as risk adjusted instruments, that is risk adjusted rates. Now these bonds we call risk free because we think the government is the last to collapse, right? So and we think the government is sovereign, right? And earlier, of course, everything issued were not here. Actually, these were internationally called things. Now sometimes they call gilt edged. By sovereign bond, we call, sometimes we have sovereign bonds, we call them sovereign bonds because earlier most of these instruments were backed by gold in the treasury, right? So, but you know, this has a long history, and considering all these, we call them now. Now, someone outside can give a risk rating for our bonds, but inside the country, we think the government, or rather, we consider the government bonds are the bonds which are risk-free bonds. Now, when it comes to risk, I will I will explain a little bit, although it's not in my slide. When I say risk, now these are actually subject to the market risk, right? But not the credit risk. So when I say now there, it was a very common question in IBSL exams. They ask when we say treasury bonds are risk-free instruments, is this statement correct, right? No, sorry for it. When I speak, I am having this AirPod now, so it responded, right? So now this bonds. So the statement was the the government's bonds are risk-free instruments. Is this true, false, or explain your answer, something like that. So when we say risk-free, we refer to the credit risk only, right? We refer to the credit risk because these are actually subject to the market risk. Market risk is the market rate fluctuation will affect the bond price. So that means they are subject to the market interest rate fluctuations, right? Market interest rates, they are coming from the policy rates of central bank and various things are contributing. Various factors are contributing to that. That is a different area. So they are subject to, now when I say risk-free instrument, credit risk is not there, but the market risk is there. That is why we have that is why the bond market is active, and people we are able to get capital gains, and the market is popular, right? So so these are, we call them risk-free instruments. So people know what is the return I will get on a risk-free instrument. So that is the expected return on a bond, right? That is the expected return on the bond. So so that is why I say, or rather, it's the market practice. Bonds are traded for the yield it gives, right? They are traded on the yield it gives, or traded. People expect that yield from the bond, and we are now Now, when you say, okay, I expect 8% yield from this, and this bond gives us 10% coupon, right? Where do we stand? Right now, 10% coupon bond was issued some time back, but now the market rates have come down. But still, on a bond, the holder gets the coupon interest, right? Holder gets the coupon interest. But then how do we know, right? Now, this bond face value is 100. We will say bond face value is 100. So how do we know? How do I know that I should get 8%, right? I should get 8. I would now, as a buyer, I would like to get more, but the seller won't be selling it like that. Seller won't be saying, no, like, okay, the bond yield, I will sell it at 8% yield. So you buy it at 8%. So then using that yield, right? Yield is the negotiation, right? Right? Yield is the negotiation based on the market conditions. We will say, okay, I will give you 8.1. So he will say, no, I want 8.2, something like that. So there can be a little bit of a negotiation there, and then you use that and arrive at the price. You use that and arrive at the price, right? Sorry. You use that and arrive at the price. So uh, so this price is used to conclude the trade, right? So our exercise is now the calculation of the bond price. So we have been, building up from the accrued interest and the coupon interest. Now we have come to the price calculation, right? So we are using, as I said earlier, we are using NPV for pricing of bonds, right? NPV for pricing bonds. This method will consider all future cash flows, as I mentioned earlier, generated by the bond. All future cash flows generated by the bond, and will calculate net present value of all future cash flows. This basis is the bond price calculation basis, right? Net present value uh, method, and then we will consider all future cash flows generated by the bond, and we will calculate net present value of all future cash flows, right? And future coupons and maturity amount, which are the future cash flows. So when we say maturity amount, it is the face value, no? Now say immaterial of at what price you purchase a bond, right? It can be at a higher price, which we say at a premium, and it can be a lower price that we say at a discount. But irrespective of that, at maturity, right? At maturity, the issuer will pay you the face value of it, right? That is understood, no? So face value is the last amount, or the principal amount that you will be getting at the maturity, along with the last coupon. So future coupons and the maturity amount, which is the face value of the bond. So these cash flows, our exercise is to calculate the present value of these cash flows and add them together and see what is the value of this bond today, right? It will give us these cash flows. It will throughout the period. Say if it is 6 years from today, then it will give us 12 cash flows, but they are coming in future. They are coming in future, and maturity value also coming in future. So we actually use this calculation to know what is the value of those cash flows today, right? What is the value of those cash flows today? So when we calculate that, that is our one. That is our bond price. That is our bond price, right? So we will go through the calculation and see whether we can understand it, right? So I have put the formula here on the right hand side. Then you don't have to go back. You don't have to go back in the slideshow to get the formula. So PV. Now PV is the or we can say an NPV as well. But now in this exercise, I will be calculating present value of each cash flow separately and add them, right? Without trying to calculate them once, because that calculation is a bit complex calculation than this, but the same result, same formula, same thing, but then it is easier for us to understand if we do each and every cash flow separately, right? So PV is the price of the bond, and FP is the future coupons plus maturity value again, right? And then R is the yield at which the trade is agreed. N is the number of coupon periods ahead, right? Number of coupon periods ahead, right? So go back. Now this is our bond actually. I gave this details, explain these details earlier. So we straight away we go to the calculation. Now we are trying to calculate the calculating future coupons. Calculating future coupons. Now we are not bothered about the coupons already paid, right? Because they are already gone cash flows, right? They are already gone cash flows means we are not we have no interest over that. We can't have any interest over that because those cash flows have already been paid, right? So after this settlement date 9/8/2010 up to 15/4/2012, we have 4 coupon dates, right? We have 4 coupon dates still maturing. So on these dates only we will be getting what? We will be getting cash flows, cash flows. 15/10/2010, 15/4/2011, 15/10/2011, and this bond will mature. Bond will mature. Maturity date is 15/4/2012, and will mature on 15/4/2012. And on this date, we will get the face value plus the last coupon, right? So these 4 are the cash flows of this coupon, sorry, of this bond, or rather we can say coupon dates. So on the coupon dates and the maturity date, right? On the coupon dates and the maturity, each day, each coupon day, you will be getting the coupons, but with the last one, you will be getting the maturity value as well, right? So we'll go ahead. And N is the period between number of coupons, right? Number of coupons. Future coupons are the coupons from 9/8/2010 to 15/4/2012. Now we are trying to calculate N, right? We are trying to see N because we already have FB, we have future value. We have already have R, and only thing we don't have is N, right? Only thing we don't have is N. So we will calculate N to complete the components of this calculation, and then go into the calculation, right? So now I am further, explaining this here. Now, now all these coupons are coming from future, are coming in the future, but we have to bring them from future to today. Today is 9/8/2010. Bring them from today to 9/8/2010 to calculate their value today. Their value today means the present value of future cash flows. So one is coming from 15/4/2012. That is the most far one, that is 15/12 to 2012, 15/4/2012. The next one is 15/10/2011, 15/4/2011, and 15/10/2010. Now these are coming from how many periods, like how many N periods. Now this has one. Now all these in between all these coupons, you have one N period, one N. That is N is equal to 1, right? Because we are calculating it for one coupon period. So here you get n equals 1 this period, n equals 2 this period, n equals 3. But now we can say, okay, this is coming from 1n, 2n, 3n. Now this is coming from the last coupon is coming from 3n to the settlement date, but not only 3n. There's this part here, that is you have to come all the way 3n's plus some more days or some more period, that is a fraction of n, because this is not a complete coupon, right? Because coupon is 15, 10, 20, 10, but our settlement is 9, 8, 20, 10. So this, and if you take this 15, 10, 20, 10 one, it won't come 1n. Actually, it is a part of n, because if it is 1n, this date should be 15 for 2010, because 1n is for one coupon period, no? So so this period we have a challenge here. Now these we know 1, 1, 1, but we have a challenge here to calculate this period, because then this last cash flow will come 3n's plus this period, 3n periods plus this period. Now first one will only have this period, this n, which we are going to calculate, and the second one will have 1 plus this, 1 plus this. Third one will have 2 plus this, this question mark, the period in this question mark, or rather the fraction of n in this question mark period. Then the last one will come 3n, n equals 3 plus this period, right? So then we will see how we calculate. We will go through the calculation, and then I will then you tell me whether you understood or not, right? So first step to calculate number of days from settlement date to next coupon date, right? So first step in calculating n for the broken period. Why I say broken period? It is not one coupon period. I'm just calculating n for the broken period, which is 9/8/2010 to 15/10/2010. 9/8/2010 to 15/10/2010, right? Why it is important? Because this cash flow plus the other cash flows have to travel through that period. They have to travel through that period to the present. Then only we can get exactly the number of periods or number of periods plus a fraction of a period to calculate the present value of those cash flows, right? Present value of those cash flows. So now we will just see how many days are there for the first, how many days are there for the first how many days are there for the first coupon, right? So we will be receiving, listen very carefully, right? We will be receiving the first coupon after this bond trade, or now we will assume that we are the new buyer of this, right? Or we can say on this trade, after this trade date, right? After this trade date, or after, sorry, the settlement date, not the trade date, the settlement date or the value date. After this value date, the first coupon is 15/10/2010, right? So it has to come all the way from future 67 days and reach the present day. That is, what is the date? 9th August, right? So so we try to calculate number of days. How do we calculate number of days? This 67. Now we have 14 days in October. That is 15th is the payment date. So we have 14 days in October. We have 30 days in September. and we have 23 days inclusive of 9th, right? Because 9th actually is inclusive in this. No, say in any investment, if you do it today, if you have it at the end of the day, that day's interest is yours, right? So the and number of days also calculated on the same basis. So we have it from 9th, right? So 23 days for August, September 30th, 30 days, and October 40. So altogether we have total number of days 67, right? So now we try to calculate. Now we said one end period is equal to one coupon period, right? So one period equals to, then now in this present coupon, right? Now we are talking about only about this present coupon, because this present coupon only has this issue. Other coupons we don't have, because we have entirely those coupon periods, right? So this coupon period, right, has already, we have calculated, when we calculated accrued interest, we have already calculated 183 days, right? We have already calculated 183 days for this particular coupon, that is the current coupon period. So then now this coupon will have 183 days, but out of that, now to reach this 183 days or reach the maturity date, from the settlement date, we have 67 days, right? So if 1n equals 183 days, right, 67 days is equal to what fraction of n? 1, in the sense what fraction of n. So we divide 1 by 183 days and multiply it by 67. So it gives us this kind of an answer, 0.36612.2186. But what we do is we take 4 decimal places for our calculation, right? So this question mark period is not 1. You understand? No, this should be less than 1, and this period is less than 1, and this is now we have calculated 0.3661. So because this whole coupon starts somewhere in April, that is exactly precisely 15th April. So 15th April to 15th October, it's 183 days, right? So that is that 183 days equals to 1n, in the sense n that is, if 183 days period is 1, then 67 days period. That is how we do this calculation. So 1 divided by 183 days, then you get 1 day in figure. Then you multiply it by 67, then you get 67 days in figure. So 67 days in figure is 0.3661, right? So we go back to this. So now this cash flow we are getting on 15th October 2010 has to come all the way from future 0.3661 period, 0.3661 period to the settlement date, 0.3661 period to the settlement date. And 15/4/2011 cash flow will travel 1 plus 0.3661 periods, right? 1 plus 0.3661 period to the settlement date, right? Then 15/10/2011 cash flow will travel 1, 2, and 0.3661 periods, right? So from year 1 and 1 year 2 and 0.3661. So the last cash flow, the 15/4/2012 cash flow will travel 3 n periods plus 0.3661 n period. So that altogether it will be 3.3661 3.3361, right? Altogether it will be 3.3361 for this cash flow, 2.3661, right? Here, sorry, the last one 3.3661, the second one 2.3661, the first one or rather the one before one 1.3661, and the closest one is 0.3661. So now here I have given you this cash flow one. So if we take all the cash flows, we can, you know, we can arrive at n for all 4 cash flows. So I will explain you the cash flows again. Now first cash flow is 1,712,500. Why? This is the coupon payment which will happen on 15/10/2010, right? So this is the first cash flow after the settlement date, which will happen on 15/10/2010, and n equals 0.3661, right? And the second cash flow is 1.712,500, again another coupon, which will have an n value of 1.3661, 1.3661. And the third cash flow, which will happen on 15/10/2011, 15/10/2011, will have 2.3661 n, right? That means it has to come from future to present 2.3661 coupon periods, right? That is exactly what we are talking here, what I have explained. Now this cash flow 4, right? Cash flow 4 has 51,712,500. Why? The bond is a 50 million bond, right? This bond is a 50 million bond. This bond is a 50 million. So face value 50 million. So you get the face value at the maturity, right? You get the face value at the maturity plus the last coupon. So you get 51,712,500. 51,712,500. This is the cash flow in the future, right? In the future, right? How far away? It is 3.3661 coupon periods away from present, right? So it has to come all the way from future, 3.3661 periods to come to present, right? So first 3 cash flows are the coupon payments. Now I have further explained here, because later on even you can understand by looking at this. These are simple, but then you know you tend to forget sometimes if you are not using them regularly, right? I explain like this because I have been doing day and day out for last 18 days the same thing, right? So maybe we have come across so many deals like this. So although we don't do manual calculations, the same principles apply. So you refresh your mind. So it's sometimes if you are seeing this for the first time, then it will be little bit, you know, you feel like it is little bit complex, but it's not, right? It's not. It's the practice only will, you know, bring you up to a level where you understand things very easily. So we will do some questions. I have some sums actually for you all to do in the class. We will take few minutes, maybe not today, maybe in the next session I'll send another presentation to upload. So so then you can we can do together some calculation and see whether you also arrive at the same answer. But now here, now you see last cash flow at maturity equals coupon plus maturity value. This is simple. But then now we have all the relevant data for our calculation, right? Now, please let me know before I proceed whether you understood up to this one. I would say 100%, or do I have to explain again the calculation maybe from here, like, okay, I have not the future coupons, yeah, calculating n, right? So please let me know. I will then go through it again, taking few more minutes, because everyone we have to go together, right? Please speak up.
Clear for me, sir.
Clear, no? Anyone else who has any doubts, please speak up. Don't worry, because this is actually I haven't seen this even when I went for different courses. I haven't seen this type of a thing because now we did ACI, ACIOC, and some other things which are required for the treasury, because like you all, we also need to get qualified in certain areas, but most of the exams you we get the theory, but I thought of a little bit I thought of doing a little bit in a little bit different way by matching this theory to the practical scenario, because we say these are the practical subjects and we do every day this we put this into our practice, right? Although we don't do these manual calculations, knowing the basic things and knowing the basis actually is very important, because you won't go wrong. And even when you like even without calculating, you will be able to tell few things, like, okay, and when you see the calculations, if there are some errors in that, you can spot them right away, because you know that it cannot happen like that when you know the basis, right? Rather than now these days, actually, since we are using the Moncal and the systems, it's people are not bothered to know what is the basis of this, so they just we just accept what we have. That is okay, that is fine enough, because you don't have to crack your heads to do all these calculations. But once in a way you do this type of thing, and understanding this is really important to build up a very good career. That is because then you will be acknowledged by others, right? So I actually share my experience here with you for you to get a bit encouraged on this. So these are very good areas. Even sometimes you know uh, some people whom I did not expect me to ask this have sometimes inquired about this, because these are not day-to-day things. So people, although people use this, but they tend to forget. So but when we are in the subject, we should we should know and refresh time to time, right? Okay, uh, I'll go ahead with this with the understanding that you all understood this. And now when I take these again, these are the 4 cash flows we are now worried about, and these are the cash flows which we need for our calculation, right? We are not bothered about the paid ones, paid cash, because now this bond is a 6-year bond, and it has altogether it has 12 coupon payments, or 12 cash flows. 6 into 2 is 12, right? So out of 12, 8 already have gone, right? 8 already have passed. That is past, right? Past. So we are worried about the future cash flows. So we have 4 cash flows, and we know these are the coupon payments. This won't change, because this is actually calculated at a fixed coupon given by the issuer at the time of the issuance, and then will be paid by the, now in this case, since it's the government one, will be paid by the central bank, right? Now, for your understanding, now I don't think most of you all have joined after we went to scriptless securities, right? Am I right?
Yes, sir.
Yeah, that's the thing. So those days, that is before 2004 February, we have these bonds and bills in script form, that is in paper form, right? That is in paper form. So you get the printed one. Now, not like the now, it was actually all manually handled, right? So I would like to share some experience with you with regard to the coupon. This coupon name comes from that we had little pieces of paper with this. Now, say if we take this, if I buy this bond, right? Now, before 2004, now this has four cash flows, so it will have this 1.71 to 500 small pieces of paper printed with this amount, and four of them will be attached to this bond, right? So what we do is what we did was we actually cut that on the before the coupon date, maybe I think maybe a week before the coupon date, we cut this small piece of coupon and then send it to the central bank with a letter to get the credit. So that is how it was settled. Now, of course, on the coupon date, they credit our RTGS account, or rather our central bank account, right? So now it has become very easy. But those days you have to keep a track on that. And at that time, maybe before 2000, most of the banks, they didn't have integrated treasury management systems, right? So all manually monitored, right? So and share with you another thing, like sometimes these bonds are called plain vanilla coupon bonds, right? Plain vanilla bonds, right? You heard that name, vanilla bonds, right? Anyone have heard that word, vanilla bonds? They call them vanilla bonds. Vanilla is the when you say a vanilla bond, it will have because we have although we don't have here, the bonds will have different features. Now bonds have bonds have come a long way through, and then they have features which are not actually bond features sometimes. Now we have bonds like that, right? One is the zero coupon bond. Zero, now we don't have them here, but zero coupon bond, which is actually issued for the face value, but there's no issued for the face value at a discounted price. So the difference, it's like more or less like a treasury bill, right? So when I saw this word vanilla bonds, I searched everywhere, like I searched in the web and all these places why they are called vanilla. One place I found, I don't know whether it's 100% correct. One place I found that they say vanilla bonds to the very basic type of bonds, because very basic types are called vanilla. Vanilla ice cream. So they have given that example there in that book, vanilla ice cream. So when you say vanilla, that is very basic type. So that is one of the things I have come across a little bit, awkward sometimes thing in this subject. So just want to share that with you because it came into my mind when I, went through these coupons. So this little piece of coupons were attached to the bonds for us to send to the issuer and get the coupons on time, right? So here now we will move on to, now we have about 5 more minutes, but we will move on to the calculation, and we will see how we can achieve the bond price by using net present value formula, right? So this is the first cash flow, right? This is the first cash flow. Calculate present value of cash flow 1, right? So now you get 1,712,000. Now what is the date? Actually, I haven't put the date here. The first day, first cash flow future date is 15/10/2010, right? This is the cash flow of 15/10/2010. First one, right? Cash flow 1. Cash flow 1 is this one, 15/10/2010. This is the first cash flow, right? So we are trying to calculate the present value of that cash flow. So we know the cash flow 1 has a future value of 1,712,500. What is this R? Now R is the yield to maturity, and we can say our expected return on this, right? Our expected return on this if we keep this bond till the maturity, right? That is yield to maturity. So you get yield to maturity. So I divide it by 100 because it's a percentage, right? 8.7%, right? So I divide it by 100, and right, I need to adjust this interest for this particular coupon period. This is for one year, no, 1 year, right? So I divide this rate by 2 because I am talking about 6 months period, right? Here also I am 6 months period. Here also I am talking about 6 months period, and this is also equal. That is, this is an equal payment in the sense, it doesn't, it doesn't depend on the number of days. We don't calculate it for number of days coupon. So it's straight away half of the coupon you get semi-annually, half of the full coupon. Full coupon is 8.7. So likewise here also we need to, when we do a calculation, we need to follow the same principle or same basis, you would say, same basis for that calculation for each and every factor. So here I divide it by 100 to get make it make it decimal, and then divide it by 2 to get the to adjust it for the 6 months period, and you get n here into the power n. That means n period, it has to come from future, right? So 1,712,500. Now when I do this part, first part, the answer is, you can do this. It's very easy. You can use the calculator and do this. It's 1.0435, right? 1.0435, right? And you need to do this first. You need to do this first before you use this 1,712,500 figure. That is the face value. So when you when you have the power of this power of 0.3661, power of 1.0435, this is not multiplication, this is the power of, then you get 1,015,710,839, right? So this 1,712,500 you divide by this figure, 1,015,710,839, you get this amount, 1,686,011.35, right? Now this is the present value of this cash flow. Present value to what is the date? What is the date we are what is the date we use as the present? That is 9th August 2010. 9th August 2010 is our present day, right? So we need to calculate the present value of that day of this future cash flow. So we have calculated for the cash flow 1. We have calculated for the cash flow 1. So we get this figure. Likewise, we calculate for the cash flow 2, flow 3, and flow cash flow 4, and then add all these things, and then you arrive at the full price of the bond, right? So I will stop at this point. Now what you can do is, since you have the presentation with you, you can go through all these cash flows and you can make an effort to calculate this, right? You please do that, because now once I do finish this, it won't take much time for me to finish this, maybe another 15 to 20 minutes. Tomorrow, not tomorrow, Friday we are having again, right? So Friday I will give you, I will ask them to upload another example, and then we will work together that, right?
Yeah, we are going to have a class tomorrow, Mangala.
Not tomorrow, Friday we have, no?
No, Thursday, tomorrow we have, but not on Friday.
Thursday, no? That is, we have Tuesday, Wednesday, and Thursday, no?
That's correct.
All right, okay. Okay, we will then, sorry for it. I just thought we don't have tomorrow and Friday only we are having. But anyway, it doesn't matter. So you can go through this, and maybe tomorrow morning I will be able to give the examples. I have a few examples with me. Actually, these examples I have used in last sessions as well. So you can go through this and practice a little bit and come to the class. Then once I finish this, I will do a fresh sum together with you, right? Together with you, and I will then you can know whether we are, then I can know whether you understood this properly, and you should be able to benefit out of this and have confidence in this for the bond price calculation. So we will call it a day, and good night for everyone. Please go through this, right?
Mangala, a small suggestion.
Yes.
I did want to stop you 10 minutes ago to explain on the assignment because you
Right.
are going on the full
yeah. Sorry for it, Mr. Ratnagiri.
No, you are explaining the full stream.
Yeah.
But when I had a little bit of feedback from the money broking houses, almost of the students, I got the feedback that some of them are a little bit behind.
All right. Yeah.
And
sure.
The bond calculation being the comparatively difficult area other than the foreign exchange swap calculation.
Correct.
Swap calculation. What I suggest, Mangala, is that if you can summarize or re-explain tomorrow morning.
Right. Okay. Sure.
Tomorrow
I will do it.
What we explained today. So then in that case, the students who could not understand and who were reluctant to ask a question will also benefit.
No worries. I will do it. I will explain it. I also felt that because, if you are listening this for the first time, it will be a bit difficult sometimes, but this is not very complex. Don't worry about it. I will explain it again. Only thing what you can do is, since you have the tute now, just try to go through it. Even if you don't understand, just read it through. Then it will be easier tomorrow when I explain for you to understand, right?
Yeah. Thereafter, when you do a couple of sums on the same lines, they will have a very good understanding. They will
that's how we did. That's how we did. And actually, I really was happy with this thing, because last few occasions when we did Mr. Ratnayake, we got a very good feedback that they really appreciated to have this calculation, because now basis, now I'm not telling that you can go through the books and read and understand this, but only thing here, we are trying to bridge this theoretical framework into the practical scenario. So that is very important.
Thank you, Mangala.
Right. Okay. Okay, we will explain before we start the class tomorrow. We will explain the assignment, and then we will I'll go through this again.
Yes.
Right. Okay.
And
I completely forgot about it. No issue. Right. Okay.
No problem. And for the benefit of the students, we have prepared an assignment for you for the second semester as explained, it will carry 50% of the marks, and plus the exam will carry the next 50% of the marks. And we have uploaded that to the classroom. You can read it tonight, and we will explain it first thing in the class tomorrow, before Mr. Mangal Karunaratne explains the for the second time what he explained today about the bond calculation. All right?
Yeah, right. Yeah, that's good. Yeah.
All right. So at the final stages, has anyone got any question to ask Mr. Karunaratne or me?
Yeah, if you can ask me, then if you can ask me, someone ask me, then it will be easier. Then I can elaborate more on that area if I can get a feedback. Yeah,
that's true. Yeah, now the time is 6:35. It's not fair for us to keep them anymore.
Yeah, what I can do is even if you want, I think it's permissible, no, Mr. Ratnagi, you can email me if you want. Like then I can go through them and come to the session. Then I will know exactly the points I should elaborate more. Shall I? How can I give you? Shall I read my email address?
Yes, you can read it out. Yes.
Yeah, you can email it to my office mail, Mangalak, MANGALAK. One word, right? Simple one word. Mangalak at ceylon.lk.
That's easy.
That's easy. Yeah. So then don't hesitate to send anything, right? I know that this is sometimes, sometimes it looks like a complex calculation, but we can go through it and then, clear out our doubts and have more good clarification on the doubts.
Yes.
So you can write to me and say where you want. Then I will explain the entire thing, but then if you write to me, then it will be easier.
Yeah, those areas need more focus.
Yeah, that's the thing. Feedback is very important.
Yes. All right. So then again, to remind, assignment is assignment on bonds and bills are uploaded to the classroom. And then please read it and come tomorrow at 5 o'clock. We'll explain it further. And then Mr. Mangal Karunaratne will explain the bond calculation for the second time.
Yeah, you can get the full benefit. I'm not just, just want to share this point because you can get the full benefit of my experience as well and the knowledge, because for the classes and for practically here and in different scenarios, like we had 2 cutovers for the systems and all this time, Mr. Ratnayaka, I went through maybe about say more than 1,000 times through this calculation. Yeah, so even for the vendors, we explain this calculation, and there were finer points that vendors missed, and they didn't get the exact amounts, because you can't go wrong in that calculation, no, because now we are dealing with a counterparty. That counterparty also should have the same calculation. There can be cents or rupees differences. So I went through this over last 18 years so many times, maybe more than 1,000 times, because when we did in classes also maybe 100, 150 times we did the same using the same formula, right? So participants can get that knowledge from me by actively participating, right?
And it is a common calculation globally.
Yeah, this is a very common calculation. This is a very common calculation, and someone said, like I can't remember, I have read in a book, they have said like 70% of these finance calculations, they use this 75% to to arrive at different aspects, for different aspects, not only for bond calculation. It will be really a useful thing. So I make it a point to master this calculation, because actually it helped me a lot to develop my career also up to this. I mean, we have various other things as well, but you know, this type of a thing, it's very useful to know, because any forum anywhere you can explain. If someone asks you, okay, you are in this firm, what is the basis of this bond pricing, right? So then, and when there's some issue with the bond pricing, or when there's some issue with the yields, and when the markets move, it is very really good to know about it, because the you know because outsiders look at you as experts, no? So you should be able to explain very well, right?
That is true.
Okay. Yes, that's the thing. So that's really, I really want you to learn this, and get into this, and that's why we will spend some time, because that's why Mr. Ratnayak has gave me a full 9 lessons, right? So that's kind of him, to give me such a time, because otherwise there's no use. I can say, I can put the formula and go through this and finish it off, but purpose is not that. Actually, you should be able to calculate like me at the end of this session.
Yes.
Right. Okay. All right. Thank you very much for